Welcome to our YouTube channel. Today, we're diving into the world of finance to uncover 12 must-know terms for new investors. Whether you're just starting or looking to expand your financial knowledge, this video is your ticket to understanding essential concepts. Stick around till the end, hit that subscribe button, and don't forget to give us a thumbs up to support our content. Let's learn together and boost your investment know-how. Number 1, buy the right investment. Investing in the right stock isn't a walk in the park. While it's tempting to look at a stock's past performance, foreseeing how it'll fare in the future is quite challenging. To truly thrive in investing in individual stocks, you'll need to roll up your sleeves and delve deeply into company analysis while effectively managing your investments. Dan 𝐈𝐸𝐞, a seasoned financial planning strategist, emphasizes that professionals meticulously scrutinize company statistics in a way that surpasses the capabilities of most individuals. This higher level of analysis makes it an uphill battle for individuals to consistently succeed over time in the investment game. When conducting a company analysis, the fundamentals like earnings per share or price-earnings ratio are crucial starting points. However, this is just scratching the surface. It involves a comprehensive evaluation of the management team, identifying competitive advantages, and meticulously examining financial documents such as the balance sheet and income statement. Even these comprehensive analyses are only the initial steps. 𝐈𝐸𝐞 advises against the simplistic approach of investing solely in your favorite company or product and warns against overly relying on past success as a reliable predictor of future performance. Achieving success demands a thorough study of the company, attempting to foresee its future direction, an intricate task, particularly in prosperous times when predicting becomes more complex. Number 2. Avoid individual stocks if you're a beginner. When people share their big stock success stories, they often forget to mention the investments that didn't do well over time. This can make others think they can easily make lots of money in the stock market, but sometimes luck plays a bigger role than skill. While you might get lucky picking a single stock, staying lucky over time and avoiding big losses is tough. Consistently making money in individual stocks means knowing something about a company that the market hasn't figured out yet. But here's the catch. For every person selling a stock, there's someone else buying it, both thinking they'll make a profit. So competition is tough. Financial expert Tony Madsen points out that many smart pros work in this field, and if you're new, beating them is pretty tough. Here's an option. Instead of individual stocks, consider index funds. These can be mutual funds or exchange-traded funds, ETFs, that own lots of stocks. When you buy shares in an index fund, you're actually investing in all the companies in that index. Unlike stocks, these funds might have yearly fees, but some are free. They can be a safer bet compared to picking individual stocks because they spread your investment across many companies, reducing the risk of relying on just one. Number 3, create a diversified portfolio. Imagine an index fund as a box of chocolates that holds many different types. If you own a broad index fund based on something like the S&P 500, it's like having chocolates from hundreds of companies across various industries. But you can also get a smaller box focused on just one or two types of chocolates, which is like a narrowly diversified fund. Diversification is like having different flavors of ice cream in your freezer. If one flavor goes bad, you still have other flavors to enjoy. It's the same with investing. Spreading your money across many stocks reduces the risk of one bad stock ruining your overall investment. And surprise, it can actually make you more money in the long run. But when you buy just one individual stock, it's like putting all your hopes in one flavor. If that flavor goes bad, your ice cream experience isn't so great. The easiest way to get this diverse investment mix is by buying an ETF or mutual fund. They already include a mix of stocks, so you don't need to stress about analyzing each company. Financial expert Dan Keaty suggests this might not sound super thrilling, but it's a smart way to begin investing. Plus, it helps you avoid thinking you're a genius who can pick all the right stocks at the perfect time. Diversification isn't just about having lots of different stocks. It's also about spreading your investments across various industries. Stocks from similar industries might all move in the same direction for similar reasons, so mixing things up helps reduce risk. Number 4, be prepared for a downturn. Investing in stocks is like being on a roller coaster ride. Sometimes the stock market goes up and sometimes it goes down. This fluctuation causes losses from time to time, which can be tough for most investors to handle. When you diversify your investments, it's like having different toys to play with. If one toy breaks, it's not a big deal because you have others. But if one particular toy is super important and it breaks, that's a problem. Similarly, if one stock has a massive impact on your overall investment and it goes down, it can be problematic. So, if one stock can significantly affect your money situation, maybe investing in individual stocks isn't the best idea for you. Even if you invest in index funds, which include lots of different stocks, they can also go through ups and downs. So, there's always some risk involved in investing, no matter what you choose. Financial expert Tony Madsen notes that when the market changes, people often want to step back or question their decisions. But it's crucial to stick to the plan, even when things get bumpy unexpectedly, as they did in 2020. Investing doesn't come with guarantees. Stocks don't promise that you'll always make money. If you're seeking something more assured, a high-yield CD might be a better option as it offers a more predictable return. Understanding market fluctuations, known as volatility, can be tricky for both new and experienced investors. Dan Keaty emphasizes that people tend to notice volatility more when the market goes down, but it's present even when things are going up. It's just less apparent. So remember, what goes up can also come down in the world of investing. Number 5, try a stock market simulator before investing real money. A stock simulator is like a practice platform for investing. It's an online tool where you can pretend to trade stocks using virtual money. This way, your actual cash stays safe. It helps you see how you'd react if it were your real money gaining or losing. According to financial expert Dan Keaty, using a stock simulator is beneficial because it can show people that they might not be smarter than the market. Sometimes, we believe we can always pick the best stocks or perfectly time buying and selling, but that's not always true. If you're unsure about why you want to invest in stocks, it's helpful to ask yourself. If your goal is to outperform the market or pick only the best stocks, trying out a simulator can give you a reality check. It's like a test run to see if you're actually good at it. But for a more serious long-term investment strategy, Keaty suggests diversified options like mutual funds or exchange-traded funds, ETFs. These spread your money across many stocks, reducing the risk of relying on just a few. They're a safer choice for most investors, including financial experts like himself. Number 6, stay committed to your long-term portfolio. According to Dan Keaty, investing is a long-term game. He suggests steering clear of the daily news about finances. Why? Because by skipping this daily news cycle, you can develop patience, something vital if you want to stick with investing for a long time. If you constantly check your investments or keep an eye on financial news every day, it might make you feel overly worried or overly excited. This can affect your decisions, especially if you're just starting out and haven't quite mastered your emotions when it comes to investing. Keaty points out that sometimes the news focuses entirely on negative stuff, and that can be a lot to handle for people. It can get overwhelming, especially when it's all bad news about the market. So here's a tip for beginners. Set up a schedule to check your investments, like putting it on a calendar. Stick to this plan. It prevents you from making rushed decisions during volatile times or missing out on the benefits of a good investment. This way, you won't sell a stock hastily just because things are bumpy, and you won't miss out on profits from a well-performing investment. It's like having a steady plan to guide your decisions and keep your emotions in check while investing. Number 7. Start now. Trying to find the perfect moment to jump into the stock market usually doesn't work out well. Why? Because nobody knows for sure when it's the absolute best time to start. Investing isn't about finding that perfect moment. It's about playing the long game. There's no perfect time to begin. Dan Keaty highlights a crucial point about investing. It's not just about thinking, it's about taking action and starting. And starting now is key. Why? Because when you invest now and continue doing it over time, something magical happens called compounding. It's like a snowball effect that can really boost your results in the long run. So, the sooner you start, the more time your money has to grow. If you're thinking about investing, the most important thing is to actually get started. And it's not just about starting once. Having a consistent savings plan over time is crucial. This way, you steadily work towards your financial goals. Investing regularly and consistently is like planting seeds that grow into a strong financial future. Number 8. Avoid short-term trading. Deciding if you're investing for the long haul or just a short while can shape your strategy and whether investing is even the right choice. Short-term investors sometimes have unrealistic hopes of making quick money, but research shows that most short-term investors, like day traders, actually end up losing money. Why? Because they're competing against big investors and super smart computers that understand the market way better. Something new investors should know: buying and selling stocks often can cost a lot. There are taxes and fees, even if the trading itself seems free. If you're investing for a short time, there's a risk you won't have your money when you really need it. Financial advisors like Madsen suggest being careful with money you'll need in less than a couple of years. It's risky to put this money in the stock market because it can go up or down a lot in a short time. Depending on what you want with your money, options like a savings account, a money market account, or a short-term CD might be better for short-term goals. Experts often say it's good to invest in stocks only if you can keep the money invested for at least 3 to 5 years. If you need money for something specific in the next couple of years, it's safer to put it in low-risk options like a high-yield savings account or a high-yield CD. Number 9. Keep investing over time. Putting your money into the stock market might seem like a one-time thing, but those who truly grow their wealth do it slowly over time by regularly adding money to their investments. This means having a solid saving habit, setting aside a portion of your paycheck to put that money into the stock market. By consistently adding more money, you can grow your wealth faster. You might already be doing this without realizing it if you have a 401k retirement account. It takes a bit of money from each paycheck and invests it in the options you've chosen. Even if you don't have a 401k, many brokerage accounts allow you to automatically transfer money into your account. Then, you can set up automatic investments through a broker or use robo-advisors, which are services that help manage your investments. Automating the investment process means you set it up to happen regularly without having to remember or make decisions each time. This helps keep your feelings or emotions from affecting your investment decisions. Number 10. Embrace regular investment contributions. It might be tempting to make a one-time investment and call it a day, but successful wealth building often happens gradually over time. Instead of a single lump sum, real growth often comes from consistently adding money to your investments. This involves a strong saving habit, setting aside a portion of your earnings to continually fuel your investments. Consider it like feeding a piggy bank. The more you put in, the more it grows. This disciplined approach, advocated by seasoned investors, contributes significantly to accumulating wealth. If you have a 401k retirement account, it's likely already practicing this habit for you. This account automatically deducts a portion from each paycheck and invests it in your chosen options. Even without a 401k, many brokerage accounts offer automatic transfer options. These can be set up for regular contributions, ensuring a steady flow of money into your investments. Automating these contributions removes the need for constant decision-making or remembering to invest regularly. By cultivating this regular habit, you're less likely to let emotions sway your investment choices, fostering a steady and consistent growth in your financial portfolio. Number 11. Utilize compounding to your advantage. Ever heard of the snowball effect? Investing works in a similar way through a magic called compounding. When you invest, your money has the potential to grow not just on the amount you put in, but also on the gains generated over time. The longer your money stays invested, the more it can grow, thanks to this compounding effect. Imagine it like a snowball rolling down a hill, picking up more snow as it goes, getting bigger and bigger. Similarly, when you invest regularly and consistently, your investment gains start earning their own gains. Over time, this compounding effect snowballs your initial investments into something much larger. Financial experts emphasize that the earlier you start, the more time your money has to compound and grow. It's like planting a tree. The best time was years ago, but the next best time is now. So, even if you're starting small, those regular investments can build up into a substantial nest egg over time thanks to compounding. Number 12. Avoid emotional investing. Investing isn't just about numbers. It's also about controlling emotions. When the market is on a wild ride, ups, downs, and unexpected turns, it's easy to let emotions take over your decisions. Fear might prompt you to sell during a downturn, or excitement might lead to impulsive buying during a surge. Financial experts advise against making hasty decisions based on emotions. Emotional reactions can lead to buying high when prices are high and selling low when prices drop, which can harm your returns. Instead, strive for a calm and rational approach to investing. By establishing a well-thought-out investment plan and sticking to it, you'll be better equipped to navigate market fluctuations without being swayed by short-term emotions. This approach helps you stay focused on your long-term goals, ensuring steadier and more strategic investment decisions. I recommend you watch the next video in our series. Don't hesitate to share this video, subscribe to our channel, and share your thoughts in the comments section. Thanks for watching.